This time around, we'll be looking at how do we manage interest rate risk exposure using this new strategy. And what is that strategy? This time around, I'm talking about options on interest rate futures. Remember that interest rate futures is one of the strategies that you can use. Just the same way we had FRA, the forward rate agreement. And later on, we looked at options on FRA, which is also referred to as IRG, interest rate guarantee. This time around, I'm looking at options on interest rate futures. So it's similar concept with FRA, but remember, FRA and futures are totally different things. Yeah. So in as much as it's similar in a way that the options on interest rate futures is the same as interest rate futures. The only difference is that if you do interest rate futures, you have an obligation, you must perform. But when you put an options on top of it, it gives you flexibility on that future, which means you still have the futures, however, you will decide whether you want to use it or not. And you have to pay premium. So, few things I'll just mention to you is, first of all, you need to know that you are always going to be always buying the options. Remember, what you are looking for is flexibility. So you need to buy the flexibility. So you are always buying. And what are you buying? You might be buying puts or you might be buying call. How do you know whether you should be buying puts or should be buying call? I'm going to explain later because it's totally different from the concept of FRA. This time around, you'll be using the concept of futures, the same concept of futures to decide whether it's going to be a put or it's going to be a call that you need. Very important to know that. Yeah. So beyond that, you need to also know that the outcome is similar to the future. So which means the three things we always talk about will still be relevant here. Your initial, if you decide to exercise, remember that is if you decide to exercise. So which means you're going to have the initial futures that you're buying. You're going to close the futures by doing the opposite. Yeah, this means you are exercising the option. That's when you decide to exercise. Then you have the real transaction. So once you decide to exercise, definitely those three things will now come into play. If you don't exercise, then you're only left with the rate transaction. Then definitely you're going to have premium that will be involved, because before you can say to yourself that you have an option, you must have paid a premium. So let me use this question to explain to you what the options means when we're talking of interest rate futures. Yeah. Remember, you need to know whether you need a put or a call. That's the first thing you have to decide. Do we need a put or do we need a call? So put or call. And I'm going to explain it the same way I explain interest rate futures to you. This time around, all you need to be asking yourself is what you are trying to do. How do you say it if you need to say it in terms of bonds? So which means if you want to borrow, what does it mean? If your exposure is borrowing, which means you are planning to borrow in the future, then in terms of bonds, it means you are trying to sell bonds. So which means your future transaction is to sell bond. So if you want to put an option on top of that, what you are trying to do is to buy an option to sell a bond. That is what it means in English. So this is borrowing. That is what this means. So which means if it is borrowing, you are trying to hedge. Remember, if you are using futures, you must always initiate your future transaction in the same direction as the real transaction. So your future transaction will be your real transaction. So which means your future transaction is to sell a bond, which is the same thing as your real transaction. And if you want an option on it, then buy an option on it. And what is an option to sell a bond? An option to sell a bond is a put option. So which means for borrowing, if you want to hedge a borrowing, what you must do is to buy. Remember, you will always buy an option because you are the one that wants the flexibility. So you buy a put. That's what makes the difference. That makes it boring. Buy a put on interest rate future. So which means, remember, when you exercise, your profit or gain will be determined from how you open and close the interest rate futures. Then overall impact will now be when you bring that into your outcome of your retransaction. But if it's to be a deposit or investment, if you look at it in forms of bond, what you are trying to do is to buy a bond. Because when you buy a bond and you invest, that is synonymous to buying a bond. You are the one that is giving out your money for returns and redemption in the future. So buy a bond, and if you want to add an option to it, then it means you are buying an option to buy a bond. That's what it means. And in that case, what you are trying to buy, the option to buy is a call. So which means if it's a deposit, you are using a call. So that is how you will know when to use call or to use put. And if you notice, it's directly opposite to FRA. Because FRA, when you are buying, it's a borrowing. Because you are not looking at the principal, you are just looking at the rate only. So who is paying rate? So borrowing means you are paying an interest. So paying means you are buying something. And that's how it works in that space. So you need to be able to understand how these strategies differ and how you solve it when you see them in question. Yeah, still looking at this question. Maybe I should bring this question a bit down so we can start looking at it in detail now. Yeah, let me put it here. So we have this question. Take a few seconds and look at it. Yeah, so because this is talking about borrowing, so we should calculate the result of that options edge. The plan is to borrow 10 million in a month's time for a tenure of 6 months. So it's a borrowing. So number one, we know that what we need is a put option. Now, please pay attention to this. The next thing you ask yourself is, what's strike price? And pay attention to this, please. I don't want to miss this. I'm going to use this question to explain this. How do you know the strike price that you need? See, you have 4 different types of strike prices available. What you must always understand is, if you are selling, you want the highest inflow, for sure. If you are going to receive money, if you think you're going to receive money. But remember that the option we are talking about here is a put option in this regard. And a put option in this regard means that we are selling a bond, but we are not talking about the price of a bond here. Yeah? Pay attention, like I said, so you don't get confused with the word sell. We are selling a bond, yes, but in the risk that we are trying to manage is interest rate. So at a rate, which is a paying rate, this is an expense to us. So which means, unlike when we're just look at put and say, oh, it's inflow, then want to maximize it, it's different. A put here is actually a problem for us. Is an expense for us, a liability for us, because we need to pay the interest we are talking about. In that case, we want to go for the lowest interest rate. So lowest net interest rate. That's what we want to go for. And you will understand that for deposit, it will be the opposite. You want to go for the highest net interest rate. Yeah. And how do you go about this? See, this exercise price, the first thing you need to do is to take it to interest rate quickly so that you know what it means. And this will be 5.5. This one will be 5.25. This one will be 5. And this one will be 4.75. So you already know what it means for that rate. But beyond this rate, for these exercise prices, they give us premium that are quoted in percentage. So this is 0.18%. This one is not available, so we're not going to deal with it. So which means we are going to pay this for put, pay this for put, pay this for put, in addition to all this strike price. So which means the net interest rate for a strike price of 94.75 is actually 5.43. And this one is 5.65. This one is 5.87. You see, if it was call, to be different. Because for call, all this interest that we have labeled here will be inflow. And this will be expense. So we'll just be deducting. That will form the net for call. So if we're talking about call, for instance, it will be 5.25 minus 1.02. And you have had something like 4.23 here, 4.35, 4.54. And for call, you want the highest, because buying bonds means you are expecting to receive interest. So for call, you would have gone for the strike price at this level. But for put, we want the lowest, and this is the lowest. So which means the strike price that we'll be interested in will be 94.75. So we already know that will be the strike price of our option. Once you sort that one out, then you ask the next question. How many contracts? Because remember, I always warn you, before you compute your premium on option, you need to know how many contracts you need. And you must always compute your premium on the number of contracts, because sometimes you might have some amount that you cannot hedge because of the restrictions coming from your quantity or size of your contract. So these questions already told us that the total sum we need is 10 million and each contract is 500,000. But remember, as I always told you during the interest rate future that we looked at, interest rate is driven by period. Remember, interest itself is equals to the rate times principal times tenor. So when you are dealing with interest rate risk, you must not forget this tenor. And that is why, to know the number of contracts, we are not just going to say it is equals to transaction size. The popular mistake students make is to say just the transaction size divided by the contract size. No, this will not be correct. With this one, we need to apportion with time. So we need to first of all divide it by the total tenure of the contract this time around, which is 3. It gave us. Then you multiply it by the tenure of the transaction, which is 6 in this regard. And in that case, the transaction size is 10 million, contract size is 0.5 million, and times 2, 6/3. And that will give us 40 contracts. So we know the number of contracts that we need, then our life is super easy, because now we can now go to step 4, which is to calculate premium. There is no option contract without premium, so you must calculate premium. Premium that is applicable in this question is 0.18%. So you need to do premium per contract. Always start like that, so that you know that once you have this, it's just to multiply by the number of contract you bought. So stay on the premium per contract, and your premium will always be your rate. Remember, just like it's interest expense you are calculating, that's the premium. Rate times principal times tenor. It's just simple. You don't need to memorize it. Your rate is 0.18%. You know, rate is always annual. The principal of the contract is 500. So every contract has a principal of 500,000. So put that here. And this contract is for 3 months, they told us. So we need to annualize that. So 3 months, which makes it 3 divided by 12. And if you look into that quickly on the calculator, this will give us $225. But we know definitely that we have 40 contracts. So if that's for one contract, 40 contract will be 40 times 225, which is equals to $9,000. Simple, easy. That's the premium. Now, once we pay this premium, the next thing is for us to now wait until the transaction date, which will be in a month's time. because that's when we know whether we're going to exercise or will not exercise. So we need to check whether the market has moved against us or in our favor. And if you look at what they've said about the market, they said the future interest rate, see the interest rate has risen to 7.5. So if we have an option at the strike price of 94.75, which is invariably 5.25%. So we have an option to actually pay interest at 5.25. And market has gone to 7.5. Then that option definitely is in money. So we will exercise. And like I said, once we decide to exercise, then the future transaction come in O together. So initiation begins, which is, remember, initiation is to actually sell because we bought an option to sell. We bought a put, so that's how we initiated the bond. So initiation, sold bond future at 94.75. Then we need to close it because we're exercising the option. So, which means we must have bought this bond. That means we have exercised. Because remember, the option that we buy, is that we always buy the option to sell a bond if it's a borrowing. And that is what we bought here, put. That's why we said it's a put option. So if we are going to exercise this put option, we will buy the bond future. So we exercise means that we decided to sell the bond futures because what we have is a put option, an option to sell rather, right? So it means we're going to sell that future. So that's why we exercise. This means we exercise. So that's what it means. And if we have sold bond future at that strike price, then we need to close it. And what do we need to do? We're going to close it by buying the same bond future. And the question told us that on that date, future price has moved to 93. So that will be at 93. And if you try to get the difference between that before I show you the difference, let me just write it. That is 1.75% for sure. But just to explain a bit more for you, remember, selling a bond future means borrowing. It means you are paying interest it means you're paying interest at 5.25. However, when you buy a bond, buying a bond is like an investment. So which means you're receiving interest at 7%. And you can see why this is actually a gain. So if that is a gain, then gain of future, so the gain on the future will be equals to 1.75%. Remember, this is annual rate. Always remember, please. Very important not to get carried away with this rate. It might mean a lot between you passing and not passing. So gain on the future per contract. It's 1.75%. Everything you must do it per contract. If not, you might run into problem with questions that you are not able to hedge fully. I'll keep reminding you. And the tenor is always 3 months for the contract, so you analyze it. And if you press your calculator for this, you see that For each contract, you have a gain of $2,187.5. And if that is the case for 40 contracts, which means you're going to multiply by 40, that will give 87,500 total profit. So this is your total profit on the contract. So which means out of three things, you've initiated and you've closed future, two things done, and we have this figure from those two things. Then we need to finalize it by doing the third one, which is the real transaction. And the real transaction will happen at the spot market rate, which they've already told us is at I think 7%, 7.5%. Yeah. So which means the 10 million will actually be at 7.5% in reality. So that's 7.5% and 10 million will happen. But remember that the rate transaction has a tenor of 6 months. Yeah, convert it to years. Then this will be 7.5% of 5 million, which is equals to 375,000. So which means normally this transaction will require us to pay this, but good enough, we've done some hedging and we have some savings from here. So which means the net in real time will be, we need to reduce our interest by that 87,500, and eventually the net cost will be the difference between the two, which is 287,500. And that is how interest rate futures will work when you have options on top of it. If there was no options on top of it, then you don't have the flexibility, but it doesn't make any difference in your calculation. The only difference is just that there's now 9,000 with options. That is additional cost to you. So which means even for you to finish final, you need to deduct your premium. So which means you add it, is an expense. So this is an expense. So they're both expense. And if you add that together, you have the total liability expense for you is 0. This is 5. And that's 6, trying to do it on top of my head, 9 and 3, so that's 396, no, 296, sorry, 296, that'll be 296 in total. So now you consider all the options together, yeah, add them together. Remember, this negative is showing that is an expense, but to avoid confusion, let me just take all the negatives so that we know that we're talking about them as costs. So they are both costs. Since they are both costs, it's easy. So premium is a cost, is a net cost, and that's a total 296,500. So that's the real situation on the options. Yeah, I'm saying it again. The options on interest rate futures is not different from interest rate futures. The only thing that I'm just slightly different is when you don't plan to exercise, there is no interest rate futures. But once you exercise, it's the same thing, just plus premium that you have to add to it. But if you don't exercise, only premium and the rate transaction is what you have left. Please take notes and let me know if you have any questions.